Hello everyone, and welcome back to another episode of Simply Wall Street's Market Insights. My name's Michael, and this week we'll be talking about Europe leading the defense rally in 2025. This week we're diving into one of the hottest, and let's be honest, most sensitive topics of 2025, the global defense industry. And in a year already packed with political upheaval and economic surprises, this sector is making some serious noise. Donald Trump's return to the White House in January sent tremors through global markets. We've already looked at how his second term is shaking up the auto and fossil fuel sectors, but today we're zeroing in on defense. Following a late February sit-down between Trump and Ukrainian President Volodymyr Zelensky, global chatter around defense spending reignited, and with good reason. Between ballooning budgets, new alliances, and a rapidly shifting geopolitical map, the defense industry is undergoing a transformation unlike anything we've seen in decades. So, what's happening? And where's the smart money going? Well, let's start with the big picture. But before we do that, we'll do our quote of the week and our summary of what happened in markets. Our quote of the week is from Havelock Ellis. "There is nothing that war has ever achieved we could not better achieve without it." Now, here's a quick summary of what's been going on. Let's kick things off with what felt like the Super Bowl of AI. Nvidia takes the stage at GTC. Nvidia's GTC conference has come a long way from its academic roots. What used to be a niche tech meetup is now a global spectacle, and this year's edition firmly cemented Nvidia's role as the undisputed heavyweight of AI. With 25,000 attendees and the who's who of the tech world in the room, CEO Jensen Huang took center stage, laying out his vision for the future of artificial intelligence. The headline announcement: Nvidia's next-generation Rubin GPUs. These new chips are expected to deliver a jaw-dropping 14x performance boost by 2026. That's not just an upgrade, it's a leap. But there's more at stake here. As tech giants start building their own AI hardware, Nvidia is betting big that Rubin will keep them ahead of the curve. Still, not everyone's sold. Wall Street's enthusiasm has been a bit muted, with some still questioning when or if the massive investments in AI will turn into real profits. And the competition isn't sitting still either. In China, challenges like DeepSeek are making waves with faster, more efficient models that could eat into Nvidia's dominance. So what's the bottom line? Nvidia's AI empire is still thriving, but the battle to stay on top is getting a lot more expensive. The next story was about Google going all in on cloud security. Google has plans to make its biggest acquisition ever, and it's a monster. Alphabet is dropping a staggering $32 billion to buy cloud cybersecurity startup Wiz. That's up from a $23 billion offer last year that didn't get across the finish line. Clearly, Google's not willing to take no for an answer this time. This deal is all about shoring up its cloud business, where it's still lagging behind AWS and Microsoft Azure. Wiz, with its multi-cloud security platform, could be the boost Google needs to level the playing field. Of course, $32 billion doesn't come without baggage. Regulatory approval could be a hurdle, especially given how antitrust scrutiny has ramped up under Trump's second term. So, Google is positioning Wiz as a neutral multi-cloud player, likely to diffuse some of those concerns. But investors aren't exactly cheering just yet. Google's track record with big acquisitions has been mixed, and there's some skepticism around whether Wiz can deliver enough to justify that sky-high price tag. Financing could also come into play, with the deal not expected to close until 2026. So, while Google is clearly going all in on cloud security, this one needs to be a game changer, not just a nice to have. Next up, Powell calms the markets. Switching gears to the Fed, Jerome Powell just pulled off a rare feat, making both stock and bond investors happy. At the latest Fed meeting, Powell kept rates unchanged and reiterated the plan for 2 rate cuts in 2025. That was enough to spark a rally across the board. Stocks jumped, bonds surged, and for once, Wall Street exhaled. Powell also downplayed concerns over Trump's proposed tariffs and highlighted the overall resilience of the US economy. That helped cool fears of stagflation and lifted markets out of the funk they'd been stuck in. The S&P 500 and Nasdaq bounced after weeks of selling pressure, with even speculative tech names catching a bid. Still, some analysts are urging caution. This rebound feels a little light on conviction, and without sustained buying, it could be short-lived. For now, the Fed is keeping markets steady, but the terrain is still a bit shaky. And lastly, Roku rides the ratings wave. Shares of Roku popped 6% after Guggenheim doubled down on its bullish stance, citing strong growth in both the US and Mexico. Roku is now closing in on 92 million global streaming households, expected by the end of Q1. But it's not just about viewer numbers. Roku's ad business is on a tear. In Q4, the platform side of the business topped $1 billion in revenue for the first time ever. That's a big milestone. The trend of users starting their TV time on Roku is growing, making it increasingly attractive to advertisers. And while Guggenheim did trim its price target slightly to $100, that still represents a hefty 40% upside from current levels. So yes, Roku's ad momentum is real, but with valuation questions still hanging in the air, investors are keeping one eye on the scoreboard. Now, let's dive into the main piece, where defense takes the spotlight. 2025 has seen defense stocks back in the limelight, and it's no mystery why. Geopolitical friction is running high, and Trump's second term wasted no time flipping the script. One of his first major moves? A dramatic shakeup at the Pentagon. The chairman of the Joint Chiefs of Staff is gone. The defense strategy is rethought. As for global alliances, they're all suddenly up in the air. Trump's America First stance has cast doubt on continued US military aid abroad, including support for Ukraine. What's the message he's trying to send? It's time for other nations to step up. That shift from global policeman to domestic watchdog is having ripple effects. Investors are now navigating a tangled web of uncertain US policies, rising European defense spending, and a very different global security landscape. To understand where we are now, it helps to look back. After years focused on counter-terrorism, the US exit from Afghanistan in 2021 marked the end of an era. But just as the dust was settling, Russia's 2022 invasion of Ukraine shattered Europe's sense of post-Cold War security. European countries, long accused of underinvesting in defense, suddenly woke up. Germany launched a historic €100 billion defense fund, and others followed suit. US support for Ukraine was swift and significant. Over $120 billion in aid, to be exact. Defense stocks surged. The Spade Defense Index jumped over 8%, while the S&P 500 slumped nearly 20%. But here's the twist. While share prices took off, actual production couldn't keep pace. Supply chains buckled. Companies racked up backlogs, but not revenue. Investors weren't paying for today, they were betting on tomorrow. And when we fast forward to 2025, we're in another transitional moment. Trump has paused additional military aid to Ukraine. While negotiations are ongoing, US defense giants like Lockheed Martin and RTX, once buoyed by Ukraine-related replenishment orders, are facing a cooling wave of uncertainty. Sure, global demand is still there, but with the US slowing its international involvement, future orders are now at risk of delays or even cancellations. And the market? It's been a bit jittery about that. Trump's mixed messaging hasn't helped. One day, he's hinting at halving Pentagon spending. The next, he's signing an executive order to build an Iron Dome for America. Sprinkle in a $50 billion annual budget cut proposed by the new Department of Government Efficiency, and investors are left scratching their heads. Still, some domestic opportunities remain. Spending could pivot towards homegrown initiatives like next-gen jets, warships, and cyber defenses. But the volatility? Well, that's probably here to stay. Regardless of where US policy lands, America's defense titans still matter globally. Here's a quick rundown of the major players. Lockheed Martin continues to ride F-35 sales with strong international backing. RTX, formerly Raytheon, sees steady demand for missile systems like the Patriot and Stinger. Northrop Grumman is locked in on nuclear modernization and Indo-Pacific deterrence. And lastly, Boeing, despite program hiccups, could still benefit from a ramp-up in legacy systems. But here's where things get really interesting. While the US sends mixed signals, Europe is all in. Trump's isolationist tone triggered a rapid-fire response. European nations have pulled together a staggering $800 billion to modernize and expand their military forces. The market responded in kind. Germany's Rheinmetall has skyrocketed 140% this year. As for Italy's Leonardo and France's Thales, they're both up over 85%. The defense buzz has gotten so loud, even traditional ESG-heavy fund managers like UBS are reconsidering long-held exclusions on defense investments. Now that's a big shift. And get this, the European defense rally has even outpaced tech stocks. Yes, in 2025, missiles beat microchips. Europe's promise to maintain spending above 2% of GDP adds long-term muscle to the momentum. A unified European defense front may be taking shape, and with it, a new global security heavyweight. Here are a few names to know. Firstly, there's Rheinmetall, a juggernaut in ammunition and armoured vehicles. Then there's Leonardo, a leader in helicopters and the Eurofighter Typhoon. Then, many of you know of Airbus, Europe's aerospace giant, which is now doubling down on military capabilities. And lastly, there's BAE Systems, the UK's largest defence contractor spanning jets, subs and artillery. Europe isn't the only region ramping up. In the Asia-Pacific, countries like Japan, South Korea and Australia are investing heavily in defence. Japan's 5-year, $287 billion build-up is unprecedented. South Korea is boosting missile defense. Australia's AUKUS Pact includes plans for nuclear submarines and long-range strike systems. Even the Middle East remains a high-spend zone, driven by regional tensions. And then there's China, with a $230 billion military budget and ambitions that are keeping Western policymakers awake at night. So, what's the insight here? Read between the lines. Let's take a step back. Yes, the narrative is bullish, but defense is a market that can flip overnight. Peace deals, sudden escalations, or surprise policy pivots can shift fortunes in a flash. There's a few things to keep in mind. First, valuations are stretched. US defense stocks are trading well above historical averages. A reversion to the mean could be on the cards if growth doesn't show up fast. Second, defense is cyclical. Conflict drives spending, but peace? That brings the peace dividend, where budgets are reallocated to more socially focused causes. And third, execution matters. Contracts are nice, but labour shortages and supply chain issues have slowed actual production. In 2023, even the biggest players saw revenue dips despite record order books. So here's some final thoughts. Where does this leave us investors? The defense sector is full of opportunity, but not without risk. To play this well, you'll need more than just the headlines. Dig into the companies, understand the context, and most of all, stay nimble in your portfolio. And if you want to dive deeper into these companies and hear what other investors are saying, head over to Simply Wall Street's community. It's the perfect place to find in-depth narratives, share your thoughts, or start a new conversation with other investors. And that's where we'll leave it for this week's Market Insights. To read the full piece, which goes into a lot more detail than we have here, check out the link to the article in the description. If you have any feedback, please do let us know. As always, we'll be back next week with more Market Insights. Until then, invest well.